Welcome, ladies. Today we are going to discuss a topic that is near and dear to my heart: financial freedom for women without losing your mind. Okay, maybe that's not the exact title, but most women are very overworked. Society expects us to have full careers, take care of our household, and still have time to keep ourselves fit and looking well for our spouses while taking care of everybody else. And then maybe also make our money work a little harder for us through investments. Sure, why not? Let's just do everything, right? So that is where we are. So I'm here to help you find a way to make that maybe a little bit easier. So today we're going to be talking about real estate investing with time and tax in mind. Tax is very important because if we are giving up a bunch of our income to Uncle Sam, then we have to work that much harder, right? So we're going to tackle those two issues together. So we're going to jump right into it here. If I can get my screen to work. Yep. So let's see what we're going to be covering today, right? So we're going to talk about strategies for balancing investing and a career, because most of us are trying to do both. So we'll take a look at the traditional real estate investing route that we're all kind of familiar with. And then we're going to look at how billionaires invest and how that is done a little bit different and how maybe we should be doing the same thing. So we'll talk about passive investing because that's kind of what that's all leading to. And some of you may know what that is, and some of you may not know what that is. So we're going to dive into what passive investing really is and whether or not that is the right fit for you. And then we'll talk about tax smart investing. And again, this is really important because we can be giving away a lot of our money back to the government. So we're going to talk about paper losses to offset taxes from cash flow. And then we're going to talk about how we can make those 3 to 5x what they are now, right? So we can write off that much more through a process called segregation. And you may know some parts of this, you may not know the full story on it. And then let's talk about generational wealth. If you have a family, this might matter to you. To me, it matters a great deal. I happen to have an autistic son. I need to make sure that he's going to be taken care of. So that generational wealth is really important. And there are ways that you can pass on solid assets like real estate to the next generation tax-free. So we'll talk about that. And then we'll talk about, well, before we get to that, anybody who stays with me that long is going to get a link to a free book that I have that will cover a lot of this. So if you didn't catch it on the webinar, you'll have the book to refer back to. So at that point, if you make it at least that far into it, if I haven't bored you at that point, you can get that book. But then we'll move on from there and we'll talk about empowering your financial future and basically how to make informed investment decisions, right? Investing is great, but if you don't do it well, if you're not informed about how to do it properly, then you might make some mistakes. We don't want to do that. But we also want to align them with your personal goals. So we'll talk about that. And of course, how to get started once you've figured all that out. And then there'll be some discussion at the end for those of you who are joining me live. And you can hit me with your whatever problems you have, and we can workshop through those. If you're not joining us live, you won't have access to that because I'll cut off the recording for that part. All right, so let's dive into it. First, let me introduce myself a little bit, tell you a little bit about me. So I am what's called a capital allocators. I work for investors that have money that they want to place somewhere. So I help them find things that align with their goals. So I don't work for deal sponsors, I work for the investors. I do also have a personal real estate portfolio worth millions of dollars. I have both single family homes as well as apartment complexes that I own 100%. And then I also invest both actively and passively in syndications. So we'll talk about what syndications are, but that's a great way to scale. And it does give you the option to invest passively. So I do a little bit of everything. I do invest in every property that I invite others to invest in. So I will never advise you to invest in something that I don't put my own money into. And then I offer direct investments as well as investments through funds. If anybody has questions about the pros and cons of those, happy to discuss that with you at any time. And I currently hold investments in 6 different states. I really like investing in multiple places with multiple different teams because it's a great way to diversify and spread risks. So I live in Florida. This is a pretty hurricane prone state. And I would hate to own everything here and then have like the really big hurricane hit, right? And then I've got insurance claims to deal with on every front. So I'd like to spread it out. That being said, I'm not offering any investments here today. This is just knowledge based, nothing further than that. But I'll just give you some peeks and insights into my life, right? So I'm also a business owner. My husband and I own two massage envy clinics here in Florida. So it just shows you can do real estate along with other things. And I am a busy mom of two boys, one of which I mentioned has autism. That's Carl. This is a picture of them. This is from a while ago. They were really young and cute at this age. I really love this picture. They are considerably older now, but I've been doing real estate for about 25 years now. So I'm just here to share some of my wisdom with you today. So that's what I am. Here's what I'm not. I am not a CPA. I'm not a financial advisor. I am not a broker, and I am not an attorney. I am just a business owner and a real estate investor who has been through this, and I'm sharing what I've learned. I'll give you lots of great real estate info and the basics on the top tax strategies in real estate so you can then see what might apply to you and then go consult your CPA, your tax consultant, your strategist, your planner, your attorney. By the way, a tax consultant, strategist, planner, CPA, those are four different occupations. Those are not the same things. So CPAs tend to put your taxes together once you've already done all the things. A strategist or a planner, they're going to figure out what you should do before you get to that point, right? So you should have all those people in your lives. So I'm just going to give you the strategies, and then you need to check with those professionals to make sure you're doing it all right. Okay. Um, Disclaimer out of the way. Let's talk about strategies for balancing investing and career. So this is kind of the traditional real estate route. We all know that real estate builds wealth, so we all want to do it. But you don't necessarily need to go the route of doing wholesaling, flipping, being a landlord, and dealing with short-term rentals. I mean, that's a lot. I've done all of these while juggling a career and a family. And I'll tell you, it was a big mistake. I found myself neglecting my family to chase the mighty dollar. And I don't want to see you go down that path. So ask yourself, do you have time to source deals, negotiate terms, write up contracts, screen tenants, manage and possibly evict tenants, right? Deal with all the repairs and all the things that come with this type of real estate. If you can't do this, and if you're only doing real estate, if that's all you do, then you might be able to do that. And that's great. You can do that, no problem. You may still wish to do some passive investing though, because at some point you might get tired of this. So it's nice to build that passive real estate portfolio on the side to where at some point you can just sit back and let somebody else take it. All right. So that is kind of the alternative. So let's consider that alternative in case this is not the route you want to keep going at, right? So how do billionaires invest? Because they made billions, so they must know something, right? Well, you can invest like the billionaires. They sure as heck aren't out there flipping houses. That's not the best use of their time. Whatever they made their big money on is what they should concentrate on making money on because it's what they're good at, right? So, what they do is they let real estate experts handle all the heavy lifting, all that stuff we just went through, right? They let them do that and they focus on their core businesses, right? They channel the excess funds from that into real estate via syndications. There's that word syndications again. So we'll talk about that. But syndications were once only available to the ultra rich, but they're now available to people like you and me. And we'll discuss what those are and how you can get into those because that is where most of your passive income can come through, right? And then they enjoy the cash flow and the tax benefits that typically exceed those other strategies we talked about. When I sat down and calculated, yes, this is correct. You heard that right. They do far less and make far more than those other strategies. I actually sat down and calculated my returns on my single family homes that I worked really hard to acquire versus what I am making in my passive investment. And I actually got mad at myself. I was making far more on the passive investments. And we'll discuss why that is in just a few minutes because it may not make sense that you're doing less and you're making more, but we'll explain why. It's because you're getting into bigger deals economies of scale. That's kind of the short version, but we'll dive into it a little bit more here. But basically, that's what billionaires do, and we all know examples of billionaires who pay almost nothing in taxes, and this can be controversial at times. You'll see it come up during all sorts of things, and these are some names you'll recognize. I mean, high net worth individuals like Bezos utilize real estate investment deductions and other tax benefits, right? Warren Buffett, he's primarily known for stock investments, but he also has a really large real estate portfolio because he understands you don't want to have to pay all those taxes. And that's one of the best ways to get around that. Real estate offers tremendous tax advantages, which Trump, for example, like many in the industry, maximize. And so we saw that come up during his campaign. People wanted to see his tax returns. How's he not paying all these taxes? Um, it's primarily because of the real estate. So this is not about politics. We're not going to get into any of that, but just that is what you see. But here's some individuals you may be more surprised to learn about. These individuals, while famous for their other primary careers, entertainment, media, have also built impressive real estate portfolios. Arnold, he invested in several real estate holdings, including apartment complexes and shopping malls. And that's actually where he made his first millions, not in movies. A lot of people didn't know that. Oprah, we know she has her hands in a bunch of stuff, but also apartment buildings and various commercial real estate. There's a reason all these high profile people do this, right? So let's see why billions are made in real estate. It outperforms the stock market long term. That's what it does. And this is just simply a fact. And it is far less volatile. You can watch that stock market go up and down from Monday to Friday. There are years where it makes tons of money, crazy amounts of money, and years where you lose your butt. And you better hope that's not the year you're trying to retire, right? But long term, when you average it out, real estate beats it every time. It is also subject to far less taxes than anything else. So not only are your returns higher, you're keeping a larger percentage of that because of that. And that's really one of the big powerful things about it. And you can leverage your money to buy it. This is crazy, right? So you can try going into Wells Fargo and saying, I would like to take out a $500,000 loan to go buy stocks, please. They're going to laugh you right out the door. But if you say the same thing, but you want to go buy commercial real estate with it, they're like, sign here, right? And then the crazy stuff is that you get the full appreciation value of those properties, the full tax advantages and the full deductions, even if you only paid 10 or 15 or 20% of that building and the bank brought the rest of the money, right? You get the advantage of the full value of that property, even though you may have a loan on it. So you get to leverage your money, which is really cool. It appreciates over time with very little effort. This is just the whole talk to your parents, your grandparents, ask what they paid for their house back in the day, right? We know that real estate over time just goes up in value without you really doing anything. It's just what it does. But you can also force it to appreciate at an accelerated speed. Specifically in commercial real estate, you can do this. And we're going to talk about that because that is how passive investing can have that much higher return than a lot of the other things you can do because you can force it to become more valuable much faster. And you can invest with very little time commitment. So that lets you scale more, right? Because you're not having to do more because the day to day stuff is being handled by professionals. So that's what it is. All right. So we've thrown around the term syndication. So what is that? This is basically how somebody can invest passively. It's done through syndications, and we have the 2017 Tax Cut and Jobs Act to thank for this. That act made syndications more available to everyday people. Syndications used to only be available to the ultra rich. So basically, passive investing in syndications allows multiple investors to pool funds and purchase assets that they would ordinarily not be able to buy alone, right? I can't go out and buy $100 million apartment complex by myself. But if we all team up, we can do that. Again, the bank's going to bring the vast majority of the funds. We just need the money for the down payment and the closing. So it's just pulling our resources to buy something bigger, and then we all share ownership in that. So you become true owners in the asset. You get all the tax advantages and all the perks and the cash flow and all of that stuff. But it is managed by a group of professionals that do all the day-to-day business of managing that real estate. So I was at a meetup in 2018, shortly after this became available to regular people, right? To professional folks. When somebody asked me if I preferred to invest actively or passively, I didn't really know what they were talking about, so I just said, "Actively," like, pretend I knew what I was doing, and then I went home and I looked it up. I was like, "Oh my gosh, I can do this." So at the next meeting, I was like, "Okay, how do I get started in this?" I was like, the rest is kinda history. So that's kinda how I fell into this. I really didn't know this was a thing because for so long, it was really reserved just for the ultra rich, but that's not the case anymore. So how are these syndications structured? So you basically have two sections, if you will, or two levels of this. You have your general partners, also known as GPs, and they do all the work and assume all the risk. So they're responsible for sourcing that deal and syndicating the deal, and that's why they're often referred to also as the deal sponsors or the syndicators. So if you hear deal sponsor, syndicator, general partner, or GP, they're basically referring to the same thing. So sometimes it's just one person that's doing all that, but most of the time it's a team of people that get together to do this, and they put this whole structure together with lawyers and everything else. And then you have the limited partners, okay? Their risk is limited to their investments. They are investing in the project. So that's where the 20% down payment or 25%, depends what how the deal is structured, right? But that's where your down payment money comes from and your closing costs. And the bank is bringing the rest, right? That comes from the limited partners. So that's how you can get into one of these deals without you sourcing and doing all the work. Now, the general partners usually put their money into this deal as well. There's usually risk capital that goes along to this. We're not going to get into all of that, but usually general partners put that up. And oftentimes, almost all of the times, they also put money on the LP side. But you can invest exclusively on the LP side and not have to do any of the work that general partners do and not have to sign for anything. So, what kind of properties can you do this on? Well, it's on commercial real estate. That's pretty much the only thing you can do this on that's going to make sense to do it. Commercial real estate in the residential world is 5 units and up. So, a duplex, quadplex, those don't count. But if it's 5 units or more, so think about an apartment complex, those can be syndicated, right? But you can also syndicate things like storage facilities, mobile home parks, retail centers, office buildings, anything like that can be syndicated. You can syndicate businesses, anything like that. But we're going to stick to the real estate world for now. Now, it's not for everybody. One thing that it is not is liquid, meaning you can't just enter into it and out of it whenever you want to. There's usually a business plan that might say, hey, we're going to hold this property for 3 years or 5 years, 7 years, 10 years, whatever it might be. And during that time period, your money's locked in there for the most part. Sometimes there's a refinance event or you'll get your money back, even though you keep your ownership, things like that. But you don't get to control the timeline of that. So if you need your money out at some point, you may not be able to get it, or it may be difficult. You may have to try to sell your shares back to the general partners or find another investor to take your place. So if you don't want to put your last amount of money that you may have, your only money, into something like this because it could be locked up in there for a while. Um, if you are somebody that likes to have full control of everything, you want to pick out the curtains and the paint colors, this is not for you. You don't get to make those decisions. The general partners are going to make those decisions, right? So if you need liquidity with the money that you would otherwise be investing, if you want control of that exit time frame or operational control in general, this is not for you. But it does have a lot of perks if it is something you can live with. You get the sustained cash flow like you would with all real estate. That rental income is coming through to you. You get that long-term appreciation, that increase in value that we talked about. The forced appreciation. This is in bold because we're gonna talk more about how that works in just a minute, but it is by far the thing that sets commercial real estate apart from these other types of real estate. Lower risk of economic and physical vacancy than you would in, say, a single family home, especially with multifamily. So you have a 100 unit apartment complex. If I have one tenant in one single family home and they move out, I've now gone from 100% occupancy to 0% overnight. But I still have 100% of my costs, right? I still have my loans, my insurance, my taxes, whatever else there is. But now I've got no income coming in until I get a new tenant in there. Maybe they made a mess of the place and I need time to fix it up, renovate, whatever. So I'm going to have no income for a while. That is very uncommon in a big apartment complex. The chance of all 100 tenants moving out at the same time are very low, right? So, and you work into your business plan that you're always going to have a certain amount of vacancy, usually 5 to 10%, something like that. But yeah, so much lower rate, lower risk of economic and physical vacancy. It can be completely passive. We've already talked about that. Higher return on investment due to economies of scale. So I think most people understand that as you get bigger, you get bigger scale. That's why when you shop at Costco, you get a better price, right? Because you're buying in volume. Same is true in this case. So imagine renovations, for example. You want to renovate the kitchen on a single family home, you're going to be buying all those appliances and flooring and everything at retail prices. If I am renovating a 100-unit apartment complex, I'm going to get everything at wholesale prices, right? So my overall cost per unit is going to be far lower. It's the same is true for contractors. I'm going to get better deals, probably get higher quality contractors that maybe actually complete work on time and in budget, things like that, right? Because they're going to want those continuous job because you're working at a certain skill. Your property management costs are going to be lower, everything like that. So that's why your rate return on investment is usually much higher. That and the forced appreciation and your tax savings. So they are less susceptible to market volatility than stocks. You know, somebody can tweet something or exit, whatever they're calling it now, um, and make the stock market go up or down, right? No one can tweet something and make the whole real estate market go down or up, right? That just generally doesn't happen from day to day. Easy to scale, talked about that. Very inflation resistant. This is a big perk. So we're in an inflationary environment right now. And what do you see when inflation hits? The price of everything goes up. Everything. Well, everything includes rent. And when rent goes up, that's income for apartment complexes. And when the income goes up, the value goes up of the property. So inflation actually drives up the value of your properties. So you're not losing money like you are with so many other things during inflation. And tax benefits, we've harped on this and we'll get into more of that as we move along. But I highlighted forced appreciation. So we're going to talk about that for a minute because it is really powerful. So, again, with commercial real estate, the value is based on the finances, not on the appraisal. So, it's all about what the income of that property is. It's just like a business. A business is valued based on how much money it's bringing in. Single family homes, they're valued based on appraisals, you know, what the house next to you is valued at, the neighborhood in general. Yes, you can do certain things to fix up the house and make it more valuable, more attractive to buyers, but it's still going to be susceptible to how your neighbors keep their properties, for example, right? Not the case so much with apartment complexes, really driven by the economies of it. And you can do things to change that. So you can increase the value by increasing the revenue or decreasing the expenses, right? So perhaps you allow pets, and so you can charge a pet rent. Okay, previous owner didn't have that before you bought the apartment complex, right? So you've increased the revenue there. Maybe you install some covered parking and you can charge premium parking for people who wish to park there. Maybe you have valet trash service. All sorts of things you can do. Add laundry service, whatever it is that increases the revenue. You can also decrease expenses. Maybe you renegotiate the contracts for your landscaping service. Maybe you put in LED lighting, a low flush toilets, all sorts of things. So let's say, for example, oh, well, we'll get to the example. So here's the calculation, the formula for this. The value of your property is the net operating income, or your NOI, divided by your cap rate. So cap rate is something that is kind of established in your area. It's a set amount. So I'm in Orlando, Florida. Downtown areas right now are probably trading around a 4 cap, maybe even a little bit lower. If you go to secondary or tertiary markets, maybe they're at a 5 or 6 cap. It all really depends on where you are, but every area is kind of going to have a set cap rate that all the properties are trading around. And your local brokers are going to know what that is, your commercial real estate brokers, right? So that's a set number. And then you're just going to have that income, right? So it's your basically all your revenue minus your expenses. So let's say we can increase that by $50 a month. Okay, combination of increasing rents and decreasing expenses or whatever we're doing. And let's say it's a 100-unit apartment complex. If you're at a six cap, that's going to increase the value of your property by $1 million. $1 million. A $50 change creates a value difference of $1 million. And it is not unusual that you can go into an apartment complex that hasn't been renovated in 15, 20 years and do enough improvements that you can get like $300 more in rent, or just look for other savings along the line where you can really decrease some expenses. And that will push up your value by $6 million on a 100-unit apartment complex. So that is what forced appreciation is, and how you can make money in this um, world of real estate, commercial real estate, much faster than just waiting for regular appreciation, which you're also getting, of course. There's a lot less liability than with personal rentals. You have no personal loan guarantees. The asset itself serves as collateral, and only the general partners are signing on loans. There's lawsuit protection because you are investing through an LLC. And as a limited partner, you are investing in a securities offering. And so you're protected by limited liability of your investment. So, again, the most you can lose as a limited partner is what you invested in it. If there was like if there's a foreclosure on a single family home that you buy for as a rental property, if it forecloses, the banks can take that house, right? But if that doesn't make them whole, they can come after your other assets. They can come after other things that you own, money sitting in your accounts. That can't happen here, right? So you can't lose more than you invested, which is really nice. You can protect generational wealth. 70% of wealth is lost by the second generation. And sometimes it's because you're handing down real estate and they don't know how to manage real estate. Well, in this case, you've got a professional team that's handling that. So they don't need any experience. They also can't just necessarily go sell it right away, right? Especially if it's locked up. I said there was no control over the exit time frame in some of this, right? And you could choose to invest in forever holds, things that last forever and ever, and it just generates cash flow. And that way they can't just go sell it immediately and then blow the cash and then they got nothing left, right? So for people who are concerned about things like that, I am one of those people. I really like that concept. Again, you can the properties are purchased in LLCs, so you have limited liabilities. We have seen entire estates of generational wealth wiped out because of lawsuits, right? That go all the way through the estate. That can't happen through these within the LLCs. And you can put your ownership in trusts. I do that myself. And this will protect it from, it will avoid probate, and it will protect it from excess estate taxes and keep your affairs private, which is all very nice. All right, so let's get into some specifics here, starting with deductions that can apply to any kind of real estate, big or small. In a syndication, again, you are the true owner, so all these deductions flow through you. So you get the basics that you get with anything, right? Your operational expenses, repairs, those are all deducted. You get to deduct mortgage interest, property taxes. Yes, you get to deduct taxes from your taxes. And then, of course, depreciation, which we've talked about a little bit. I've mentioned it. But basically, in case you don't know what depreciation is, it's writing off the purchase price of something over several years. And this is not something exclusive to real estate. All businesses have this for capital expenditures. So if you have a tree farm business, for example, and you buy a chainsaw to cut down trees, um, that is a capital expense. And if the IRS says a chainsaw lasts for 5 years, you take the value of that or the price of that chainsaw, you divide it by five, and that's how much you can depreciate each year. So it's kind of like that. With residential properties, including single family homes, apartments, mobile home parks, things of that nature, the IRS says that those items last for 27 and a half years. Very arbitrary, 27 and a half years. Don't know where they got that number. And of course, we know that in the world of real estate, that building isn't worthless in 27 and a half years. It's actually going to be worth a whole lot more than it is now. But the same rules that apply to the chainsaws apply to buildings. And this is the what the IRS has said. So 27 and a half years is what you depreciated. So you take the value of that property, you divide it by 27 and a half, and that's basically how much you can deduct per year in like a straight line depreciation. It's a little more complicated than that, but that's basically it. Again, I am not a CPA. So things that may not apply to all real estate. Sorry, don't know why that notice. That's for the next slide. But capital gains advantage, that's another thing that is really great in real estate. So when selling a property, capital gains are typically taxed at a lower rate than ordinary income. Ordinary income being like what you get with your W-2, your active type of work. So especially long-term investments, which is pretty much everything over a year. So if you're doing flips or something, or it might take 3 to 6 months, that's not going to count with that. But here's the rates of capital gains for 2024. So you can see, like, if you are married filing jointly, you could be making up to $94,000 a year. And if you sell something, you pay zero in capital gains, zero. Pay no taxes on that gain. If you are married filing jointly and make up to $580,000 a year, you could pay 15%. And the highest you'll ever pay in 2024, at least, is 20%. So you'll see that this is far less than your other tax brackets, which you might be paying 35% or more. Maybe you're in a state where you're paying state and federal taxes. Maybe 50% of your money goes to taxes. So obviously capital gains are considerably lower. Okay, some lesser known tax strategies, and some of you may know this, but you may not know all aspects of it. Let's talk about 1031 exchanges. So under the section 1031 of the Internal Revenue Code, investors can defer capital gains taxes by using the proceeds from the sale of one property to purchase another like-kind property. Okay, so what does that really mean? So anytime you sell something, you're supposed to pay this capital gains. But the IRS says, well, if you're just selling it to trade into another property, you're just going to buy the next biggest thing. You're going to sell the single family and buy a quadplex, for example, or sell the quadplex and buy an apartment complex. You're just trading. So let's just roll over the taxes into that next property. So it's a like-kind exchange is basically what this is. And all that means is real estate for real estate. Okay. So it doesn't have to be the same kind of real estate. You could go buy a shopping mall with proceeds you had from selling an apartment complex. It doesn't really matter. But there are some stipulations that you have to do. So first of all, you have to identify what you're going to be replacing the property with within 45 days, and then you have to close on it within 180 days. And you cannot touch the money. You have to have a qualified intermediary that holds on to the money between those two transactions. So you can never touch it. Once you do, you've lost the ability to exchange this. You also must title it the same. So that's why some people will use a tenant in common if you're going into a syndication with it. Yes, you can 1031 exchange into syndication, but because you have to keep it in the same title, you have to do this tenant in common instead of coming in as a regular LP. So it gets a little complicated, and a lot of syndicators will therefore not want to deal with it unless that 1031 exchange is of a pretty high amount, maybe $1 million or something like that, because there's going to be new legal documents that you have to prepare. So they got to hire a lawyer to take care of all that. So, but you can do it. And we'll discuss another way that you can get into these syndications with switching out one property into the syndication without doing a 1031 exchange if you don't want to deal with that. But yeah, so basically you are pushing the can down the road when it comes to the taxes, right? You're rolling into the next property and the next property, but you could potentially roll it down the road, push the can, kick the can down the road forever. And I'll tell you how you can do that. But obviously all of this needs to be planned in advance, and you got to talk to your CPA and or your qualified intermediary to do that. All right, estate planning benefits. Okay, so this is kind of where we're going here. Real estate held until death can benefit from a step up basis, reducing capital gains tax liability to the heirs. Okay, what does all that mean? First of all, you have to understand what basis means. So, that generally refers to the amount invested in the property for tax purposes. So, when you buy a property, the basis in it is typically the purchase price. As you own the property, you might do something to increase the value. Let's say you add a pool or something like that. That can then affect your basis, might step your basis up a little bit. Um, when you sell the property, the difference between the sale price and that basis is what you're going to pay capital gains on. Okay, so that's what's subject to capital gains tax. So, step up in basis at death equals the current market value. So, it steps all the way up to what the current market value is. So, what does that mean? Okay, a property is purchased for $500,000. That's your original basis. When the person dies, it's worth $2 million. So instead of, if you would have sold it for $2 million, there'd be $1.5 million worth of potential capital gains tax to be paid, or value that capital gains tax would be applied to. But no, now it steps up to the current market value. So, what does that mean? It means that the heirs, when they go to sell it, that is their new basis instead of the original basis, right? So if they sell it a few years later and it's now worth 2.5 million, they're only going to be responsible for capital gains tax on the $500,000 difference there. If they were to sell it immediately when they inherited it, they may potentially own no taxes. So imagine selling a $2 million property and owing no taxes. You can do that. So very powerful. Here's the bonus. You can combine the strategy with that 1031 exchange. Remember I said you're kicking the can down the road on those taxes? You're just building them into the next purchase, the next purchase, the next purchase. Well, at some point, we're all going to die. Hate to break it to you. But when you do that, taxes are wiped out because it gets stepped up to current day basis, current day market value. So there you go. That's how you avoid paying taxes. You die. Oh, that's morbid. Okay. Here's another tax advantage strategy that you can employ with real estate that a lot of people don't know. Many people don't realize you can invest in real estate via your retirement account. Not only can this grow your retirement account much, much faster than, say, mutual funds or whatever your employer allows you, it can do so with huge tax benefits. So the secret here is having a self-directed account. So this can be established. You can set up your own self-directed IRA or 401k if you own a business, or you can roll over plans that you already have if you own them. If you're no longer employed by the company that originally set it up for you, you can now make those self-directed, right? So you'll have to have a custodian that sets this up. So it's very unlike the traditional ones that are forced into just investing in stocks, bonds, mutual funds, right? You are able to invest in so many things in self-directed IRAs. You want to go buy gold bars, go buy gold bars, okay? But the most common thing that people do with it is buy real estate. So you can do that. So with the IRA, your contribution limit is $7,000 a year, $8,000 if you're over the age of 50. If you have a business and you are the only person that works in that business, or it's you and your spouse, you can set up a solo 401k, and this has a much higher contribution limit. So you can put $69,000 a year in that, $76,500 if you're over the age of 50. So you can see how that's very, very valuable. And then you can get all the tax benefits of investing inside those retirement accounts. So let's talk about what those are and what you may need to think about. So you're going to need to think about traditional versus Roth. You've probably heard these words, but you may not know what they mean. Traditional basically means that it's tax deferred growth. So tax deferred means you pay the taxes later. So you get to put money into those retirement accounts before taxes have come out of them. Okay. So the idea here originally was that when you retire, you might be in a lower tax bracket than you are now. And so you'll pay less taxes later. Okay, that kind of works. But if your investments are doing really well and they're going to grow and have a lot more value later, even if you're in a lower tax bracket, you may still pay more money on them. And also, I don't know about you, but I plan on making more money the older I get, not less. So that doesn't really work for everybody. So for me, I'm putting stuff in my Roth because I'm planning on doubling my money every 4 to 6 years. That's pretty much what real estate does for me. So if I'm gonna put in a couple $100,000 now and have it be several $1 million later, I don't want to be paying taxes on those millions of dollars. So in a Roth, I'm going to pay the taxes up front before it goes in, and then everything that grows in there grows tax free. So it's very powerful in that respect. Now, what works for you is going to depend on where you are in the cycle of life. If you're already looking at retirement, you may not be wanting to change that up right now, because if you change something from traditional to Roth, you can do that. But there'll be a taxable event when you do that. Now, you might be able to write that off with depreciation if you are a professional real estate um, person. There are ways to do that, but you really, really, really need to talk to a CPA, make sure you understand all of that. If not, you want to aim for years when you are due to pay less taxes. You're in a lower tax bracket for some reason. Maybe your business isn't doing so well that year or whatever. But so you got to think about that. But if you're setting it up from scratch, maybe consider that Roth, especially if you are younger. Give some thought. Talk to your CPA. All right. I promised that if you stuck with me thus far, I would give you a free resource. So this is my book, Choosing Your First Passive Real Estate Investing, a step-by-step guide. And you're free to download this for free from my website. Also, if you need to skedaddle, you can go to my link tree if you want to connect with me. I'm on all the social media platforms. You can also find me on my website, set up a call with me if there are other things you want to discuss. There's no charge for those calls ever. And yeah, and I don't sell anything on those calls, but I give lots of free advice. So if you want to learn more about passive investing and you don't have time to stick with us, by all means, please do that. And that guide is also good even if you have invested in the past and you just want to make sure you've been doing things right. There's a lot of golden nuggets in there that might be helpful to you, even if you have done investing in the past. So give it a look. It is free. Let's talk a little bit more about depreciation. That's my favorite thing. All right. We touched on this a little bit, but we're going to go into it a little bit more. First of all, depreciation is required. Okay. You will be charged for depreciation whether you take it or not. So take it. Okay. You want to do this, right? So according to the IRS, again, the useful life of residential property, 27 and a half years. So we're going to use a very convenient example here where we have a structure worth $2.75 million. Wonder why I picked that number, right? And I said structure because the land value does not count. So maybe you paid $3 million overall for the property and the land, but you cannot depreciate the land. So we're just going to talk about the structure. And so we're going to divide that by 27 and a half, and we get this very convenient number where we get $100,000 of depreciation. So that is a deduction off your taxes. Okay. So let's say you earned $100,000 in cash flow that year, and your income tax on that cash flow could essentially cancel itself out, and you'd likely owe zero in taxes. Isn't that nice? You made $100,000 and you get to keep it all. Yeah. But what happens if you have that $100,000 depreciation, but you only had $40,000 in cash flow? What do you do with the additional $60,000? Well, you can use it to offset taxes on another cash flow, that maybe on something else you had. Maybe you had another property. Maybe you sold something and there was capital gains. Anything like that. It could be applied to anything that falls into the passive investment bucket. And you might be surprised what is and is not considered passive investment. So you got to look that up and talk to your CPA about it. But you can apply it to any of that. Let's say you don't have any of it. Let's say, oh, I didn't invest in enough stuff. I don't have any of that. Well, you can carry it forward indefinitely, really. So you just keep pushing that loss forward. Remember, it's a paper loss. It just carries forward on your paper. So at some point in the future, when you sell something or you have more cash flow or anything else that's passive income, you can apply it then. So very powerful. And again, you're getting depreciation on the full value of the structure, even if it is leveraged with a bank loan. All right, let's talk about accelerated depreciation. So you thought it can't get any better than, this $100,000 we've been talking about. But what if we could turn that $100,000 into 300,000 or 500 or even $800,000? So here's how that works. So cost segregation allows real estate investors to increase the upfront depreciation by basically identifying components of the property that can depreciate it over shorter tax lives than the building itself. So tax lives, that's that whole thing where we talked about 27 and a half years is the tax life of a building. But there are parts of buildings that don't last 27 and a half years. Maybe the roof only lasts for 15 years. Maybe the doors will only last 5 years. Maybe they're crappy doors. Appliances certainly aren't going to last 27 and a half years unless they're just something absolutely amazing. Flooring's not going to last that long. So what you can do is you can segregate those out. That's what it's called, cost segregation, right? And you put them in these different categories of 5, 7, 15 years instead of that 27%. And then you can, by reclassifying them like that, you can accelerate the depreciation on those. So you don't have to divide it by 27 half. You can divide it by 5 or 7 or 15, right? So this is done by an engineering firm, okay? And so it's really only cost effective to do on larger properties. So this is one of those things for getting into those bigger deals. This is why your return on investment is higher and your taxes are lower. It's because of things like this, right? So you're going to pay an engineering firm to do this and separate out all those little things. I mean, they can do it down to the plugs on the wall, right? So all of that can be segregated out. And so now instead of getting $100,000 worth of depreciation at the front end, you can get a whole lot more. Very, very powerful. Can't get any better than that, right? Oh, yeah, it can. So here's where we got to thank the Tax Cut and Job Act of 2017 once again. So they enacted what's called bonus depreciation. So this allows you to take an immediate deduction as soon as you buy something, right off the bat, very first year. So for 2024, that bonus depreciation level is 60%. So basically, all those things that you put on that cost segregation report that the engineering firm did, 60% of that cost, eligible items on that list can be depreciated the very first year. So that's huge. I don't know if you understand how huge that is, but we have partners that are getting 30 to 90% of their initial capital back as a loss, a paper loss in the first year. So that's an incredible, incredible bonus. And here's another bonus. This is, I talked about 1031 exchanges and how some people don't want to go through that whole thing and they don't want to become a tenant in common, or maybe their property isn't worth enough that the syndicator is willing to do the tenant in common. They could use this accelerated bonus depreciation to offset the taxes instead. So they sell that property, they go ahead and they take the tax hit, but then they use the depreciation to write it off. All right. So they end up not paying the taxes. Now the tax burden's gone from it. Right. So again, you are still kicking the can down the road. There is such a thing called or depreciation recapture at the sale. You should definitely talk to your CPA about that. We're not going to get into all of that right now. But again, you can use future depreciation and depreciation that you've rolled along to keep kicking that can down the road. So there's so many strategies here. But it's important to know that they're out there because there are people who are investing in these things are not taking advantage of these things, or their CPAs are not educated in real estate. Different CPAs have different things that they specialize in, and maybe this isn't their specialty, and you need to talk to somebody that knows these things. So that's why I'm bringing them to you, so you can understand that these things are out there. But essentially, depreciation can subsidize your investments. So you're thinking, oh, I'm investing 25,000 or 50 or 100,000 or whatever you're investing. Maybe it's $1,000,000. But really, when you think about the tax implications, it could be a lot less than that. It's kind of subsidized. It's kind of cool. All right, ready to have your mind blown? All right. So the last, very most powerful tax strategy, sadly, will not apply to everyone, but it might apply to some of you. So I have to put it out there. So when I discuss depreciation and that it can be carried forward indefinitely or applied to other passive income, such as real estate cash flow and capital gains from sale of property. I allude to the fact that the IRS code basically has different buckets of income. So active income is one of those buckets. So that's what you get from your W-2s. You have the passive income that we've been talking about. That's real estate and royalties falls into that category, many other things. And then there's portfolio income, like mutual funds and dividends and things like that. And normally, income and expenses or losses from one bucket can things can only offset within the same bucket, right? Active income can only be written off by active losses, passive income by passive losses, portfolio income, portfolio losses. If you are a real estate professional, if you have that status, these buckets might not matter. Okay. And why does this matter? So this is kind of huge. All right. So this is how this works. This is crazy. So if you have a spouse that is a W-2 worker, okay, they have a regular standard job like so many people do, most of us do. But you, or this could be the other way around, right? Have this real estate professional status. You could get depreciation from an apartment complex that you invest in or a shopping mall or whatever it is. And you could potentially write off their entire W-2 income. So I actually do this, okay? My husband has W-2 income. We have the business, the massage envies and all that kind of stuff. And I do the real estate stuff. We keep those separate. And because I have this real estate professional status, the depreciation from all the things I invest in offset his income. And we end up not paying taxes. As a matter of fact, last year we got a refund, which is crazy. So this is super, super powerful if you qualify for this. But you need to really understand how to qualify. There's a lot of people who think they qualify that don't. We don't have time to get into it now. If you want to set up a call with me, I can give you more information on it, or just look it up, Google it, or talk to your CPA. But really understand it because this is something you can get audited from on the IRS if you claim this and you're not really a real estate professional. But yeah, blows your mind. Blows your mind. All right. Empowering your financial future. We're getting to the close to the end here, right? So how you make informed decisions that match your personal goals. So this is very, very important. If you're going to invest in real estate or anything, you really need to understand what you're investing in. It's not enough to just say, hey, I know real estate makes millions of dollars. Let me just go put some money into it. You need to understand how to do some basic due diligence. Okay. You need to understand what markets you might want to invest in and why. So maybe you like to invest locally close to you where you can keep an eye on that property. Maybe you just want to invest in really hot markets. Maybe you want to invest in the Sun Belt, which is really hot right now, but that's not where you live. But maybe that's what you want. Or maybe you want to invest in places that you like to go visit so that you can write it off as a business expense when you go visit those places, right? There's all sorts of reasons why you might pick one market over another, but there are also a lot of financial reasons, whether you're looking for higher cash flow or higher equity, things like that. So you need to think about the markets and what kind of assets are you attracted to? Is it apartment buildings? Is it mobile home parks? Do you like new construction? New construction can be very lucrative, but it might be a bit more risky. So the returns are going to be different in all these different asset classes. So you need to understand what your choices are. And then teams. Teams is very important. We talked about those general partners. That team is going to dictate everything. So you need to make sure that they are a solid team because they could have a great asset in a great market and not do so well with it if they're not a good team. Or a really bang up team can take a bad asset in a bad market and still do wonderful things with it. So you want to vet things like, find out how many deals they have taken full cycle, meaning they've purchased it, they've managed it, and they sold it, and see what returns they got for their investors when they did that. How many assets do they have under management? Do their strategies align with your strategies? What's their communication style? There's so many things you can ask them. And I have a whole long list of things you can ask them, and you should ask them. So reach out to me if you want that list. I'll happily share it with you. And then the most important thing is for you to understand your investment goals. And some people, They have no idea what their investment goals are. They're like, I just know I want to make more money. Isn't that a goal? Well, yeah, it is. But when do you want to make that money? How do you want to make that money? Right. So are you looking for cash flow or are you looking for equity? Yes, there are deals where you're going to get both, but you usually got to get more of one or the other. You're either going to get more money now, cash flow coming to you right now, but very little equity on the end, or you're going to get less cash flow now, maybe no cash flow now, and tons of equity on the end. New construction, you're not getting any money right now. It's all about when it sells. So, or when it's completed and you get a new loan on it and you get refinance proceeds, all those kinds of things. How long are you willing to part with your money? 3 years, 5 years, 7 years, 10 years? You need to know that. What's your risk tolerance? You know, I mentioned new construction can be very lucrative and you can knock it out of the park and make a lot of money on that. But you might not make any money on it if something goes wrong during construction, right? So versus buying something that's existing property has a 12-year track record of making a certain percentage every year, you have more an idea of where you're going. So you need to think about that. Are you building a nest egg for your retirement, investing for your children? Are you putting together a college fund? Do you want to exit your job early? Or maybe you just want to supplement your current income. These are all things you need to think about. And yeah, they're going to affect what types of investments you get into. And I can help you navigate those if you want. The free book that you hopefully downloaded, it has a whole section on this. Things to think about and how it affects which markets and assets you might want to pick. So give a look see in that chapter and try to get your investment goals straightened out. All right. We've decided on our goals. We've decided where we want to invest. Now, how do we actually do that? So, syndications come in two different formats. You'll hear them referred to as 506B offerings or opportunities and 506Cs. Okay. These are exemptions under the Regulation D of the Securities Act because what you are buying is a security. Okay. So, these are exceptions to having to do all the registration requirements that the IRS generally has for securities, which can take years. And real estate purchases can't take years. And they're very costly because you need lawyers to draft up all these papers. So this is how syndications back in the day used to be done. It had to go through all this rigmarole and why it was really only the ultra rich that ever got into those big deals because they took so long and they're so expensive to set up that you just had to have millions of dollars to invest in those kinds of things. But that's no longer the case because again, that Job Act of 2017, Tax Cut and Job Act, came up with these exemptions. So within these two exemptions, you can now invest in syndication. So 506C exemption says if you're an accredited investor, you can invest in these. So we'll talk about what an accredited investor is in just a minute, but 506C offerings are only available to accredited investors. And these are offerings that can be advertised. You can see them on a billboard, on a blimp, you can see them on Facebook, that kind of stuff. And if you're accredited, you can go ahead and invest. And whoever's issuing that syndication, that offering, they have to verify that you are indeed accredited before they allow you to invest. But somebody said, hey, not everybody can be an accredited investor. I have friends and family that want to invest in things and they should be allowed to do that. So he came up with a 506B offering. And so these are available to both sophisticated and accredited investors. And we will define what both of those things are. But you can have 35 sophisticated investors and an unlimited number of accredited investors in 506B offerings. But here's the key. They have to have a pre-existing relationship with a general partner or a fund manager involved in that syndication. And they cannot advertise that, not a general solicitation anyway. So you're only going to know that these are out there if you are have that pre-existing relationship. So how do you get that pre-existing relationship? Well, it could be a friend or family member, but it could also be someone you met at a conference, somebody you met at a meetup, on a workshop, and somebody you set up a call with. So I always tell people if there's syndicators you like, teams you like, set up a call with them. It costs you nothing, and it is super important to just start establishing that pre-existing relationship and then sign up for their email list, their investor clubs, and get involved with them so you can have that pre-existing relationship. And if you're not signed up for those emails or in their investor clubs, then they can't share with you these kinds of offerings, right? You won't ever know they exist because they can't be advertised. But if you've established that relationship, then they can send you those offerings and you can be made aware of them. Even if you're not going to invest in them, you can start looking at them, right? See if it's of interest. So, what is a accredited investor? What is a sophisticated investor? So, accredited, this is basically based on your income or your net worth. So, if your income is $200,000 or more, or 300,000 jointly with a spouse, congratulations, you're an accredited investor. That's all there is to it. If you don't qualify that way, you can qualify if you have a net worth greater than $1 million, excluding your personal home. Okay. So if you meet one of those, hey, you're an accredited investor. You just need a letter from your CPA that says that you qualify in that manner, or you have to show some tax statements or whatever. There are various ways of verifying that accreditation, but that's all you need to be an accredited investor. Sophisticated investor, you have to show. So basically, this is anybody who's not accredited but can show that they have a basic understanding of commercial real estate. They know what they're talking about. When we talk about markets, when we talk about assets, you know what those things are. You've taken courses like this, you've read some books, you've done some YouTubes, podcasting, whatever it is to educate yourself. You can become a accredited, a non-accredited investor, but sophisticated. But remember, for 506B offerings, you are going to have that pre-existing relationship in order to get into those, and you do not qualify for the 506Cs. One is not better than the other as far as the returns. They'll usually make very similar amounts. The syndicators and general partners, they don't pick one or the other based on what the return on investment is going to be. They have all sorts of other reasons why they'll choose one or the other. They can even start as one and switch over to the other. This gets all sorts of complicated, but don't think you're going to make less because something is a 506B. That's not the case. We're going to skip over this because this is running a little bit late, but basically, this is just how I got into this role. I was basically investing for myself. A lot of friends and family started seeing what I was doing, I was making money, and started asking me to help them invest. And I was basically doing this for my son and for my family. And then I realized I could help a lot of other people. So, but I'm going to share, spare you from that whole story of how that happened. But if anyone wants to know, happy to share it offline. But how can you start? If this is something that does interest you, how can you get started in this? One of the first questions I always get is, how much money do I need to start? Like, I almost sound embarrassed to ask. Like, this is a very logical question. Of course, you need that. So, yes, these are multi-million dollar real estate assets that we're purchasing, but you don't need to have that. Remember, the bank is the biggest partner, so you don't need millions. If you're investing single family homes now, you don't even need as much as you would for a down payment for one of those. Many of them, the baseline investment is only $25,000, or at least I see a lot that fall into that category. There'll be some that are $50,000 baselines. There's a lot that are 100,000. There are some that are a million. I mean, they are all over the place, but it is not difficult to find something where you can get in at 25. Even if they say the baseline is 50,000, a lot of times you can talk to the sponsor and they can get you in for less, especially if it's a fund. They can be rather flexible. Okay. Where do you find the money to start? So in my case, I sold off some single family homes in order to get into multifamily, but that is not what everybody has. And we also, if you have retirement funds, you need to have an IRA custodian to do that, to do self-directed. So that's one way to start. But the first place to look is for lazy money. What is lazy money? I consider anything in a savings account, CD, or money market to be lazy because it's making less money than inflation is. Okay. So I hear people all excited now. They're like, "Oh, I'm getting 3%, 4%, even 5% on some of these things." And they're like, "I'm finally making money." You're not making money. You're losing less money than you were before, but you're not making money because inflation right now, and it depends where you are in this country, but it's going to be somewhere between 7 and 10% right now. So you are still losing money if you're only making 4 or 5% on your money. You're losing the difference there, right? Because, yeah. So that's the first money you want to get invested because you need to be making more than inflation at least. All right, stock accounts. If you're not happy with how they are performing, leave enough in there for an emergency fund and divert the rest into real estate. Okay. How much should you have an emergency fund? And this is because real estate is not liquid. You can't pull it out fast, but stocks are. And stocks are not bad. I have a lot of money in stocks, but I have most of it in real estate. But I like to have an emergency fund where I can pull out liquid funds at any time. And so a lot of people say your emergency fund should be equal to 3 months worth of your living expenses. I think that's too low. I usually aim for at least 6 months. So I leave that in stocks or other liquid places. And then I put the rest into real estate. But that is up to you. But that is another place where you can go look for money. Retirement accounts, already mentioned those. Great place to invest. This is what I'm going to caution you about. This, I left it in here because if interest rates go back down, which the Feds have said they're going to start lowering those rates, um, this might become a viable option again. I don't think it is right now, but a couple of years ago, this was a great way to get into this kind of stuff. I knew a guy who was he had a line of credit, a business line of credit where he could pull up to $500,000 at a time. And he was borrowing that money at 3%. And then he was investing it in real estate deals that were making between 12 and 20%. That's a no-brainer. You're paying 3% to borrow the money. You're making, I think he was averaging 15%. No-brainer. Absolute no-brainer. He's making tons of money on money that isn't even his. It's basically what banks do, right? They take your money and they lend it to somebody else and they collect the difference in between. So he was basically being a bank with the bank's money, whatever. Right now, if you want to get a home equity line of credit or something like that, it's probably going to be somewhere between 7 and 9% interest. I'm just guessing. I haven't looked at them lately. But even if you are making 12 to 20% on that and you're like, well, there's still a spread in there. Remember, real estate grows in value over time. So you may hear the average return on something is, say, 15%, but that's average. It might be 4% at the beginning and 30% at the end, right? So you don't you're not necessarily going to get the same amount of money throughout the time. And so if your loan payments are higher than what you're receiving at a particular time, you might end up in trouble there. So be very, very careful when it comes to taking loans to invest. If interest rates drop and you can lock those rates in, it could be a great way to do it. Or if you happen to have some good loans that I'm not aware of, maybe that's a good. Oh, and also look at the loan term. Do you have to pay that back in 3 years, and your whole period on this other thing is 5 years? Bad idea, right? So be careful there. And 1031 exchanges. We already talked about that, but that's a great source also for getting started in this. All right. So if you're going to start doing this, the first thing you need to do is educate yourself. That's how you become a sophisticated investor. And it's also a good idea, even if you are an accredited investor. How do you do that? There are about 1 million podcasts out there on this subject right now. So there's tons of podcasts, lots of YouTube channels. Every syndicator, every capital allocator, they're going to have podcasts on this. I have it, YouTube channels, all that kind of stuff. They're going to have lots of free information on their websites. There's going to be books, and there's so much free information these days. There's no excuse to not get educated on this, and it doesn't take as much time as you think. Connect with syndicators, connect with capital allocators, and set up a call with them. You have to establish that pre-existing relationship, but it's also a great way to get all your questions answered. And on these calls, there's never a pressure to invest in anything. They can't offer you an investment opportunity on those initial calls. They can't even do it. So don't worry about that. Join those investor clubs. That will let you start seeing offerings so you know what other questions to ask. Because sometimes you don't know what questions to ask until you've seen some things, right? So start seeing those. And I know on my website, and I'm sure others have this too, I have previous deals that have passed that you can review. There are videos that go through them that explain a lot of the terminology and stuff. So there's absolutely no pressure to invest there because these deals don't exist anymore. They've already closed, right? So you can look at things like that. And then you make your first investment and you learn from that, and then you rinse and repeat. So, just so you kind of know what some of these look like, here's one we did earlier this year called Stony Creek Highlands. This was a Class A property, very nice, 278 unit property that was built in 2008 and was just being repositioned. So it was almost a $47 million purchase. Um, and you see here what the returns were. The average cash on cash, 78%, internal rate of return, 16 to 17%, and you're multiplying your investments 2.7 to 2.8 times through this whole period of 5 to 7 years. Okay. If you don't know what some of those terms are, internal rate of return, equity multiple, cash on cash, these are the types of questions you need to start learning. These are the types of things my book explains. So sometimes, like I said, until you start reviewing offers, you don't even know what questions to ask. So here's another one. This one actually says what the baseline investment is. The other one didn't mention that. It also mentions your AAR. What's that? That's your average annualized return. Okay. So that's a little different than an IRR. So you see the terminology. You need to learn these terminologies. They're not difficult, I swear. This talks about a hurdle. What the heck's a hurdle? I can explain all that kind of stuff to you. So, um, but this one's doing cost segregation and bonus depreciation. So it talks about all of that kind of stuff. So these are the kind of examples you'll see on the websites. Lots of people are going to offer these kinds of things. Another great way to learn is for you ladies out there is the Shiro's group. This is my Facebook group. I just kicked this off, so it's fairly new. We don't have a ton of members in there yet, but please join us. This is just for ladies to get together and talk about real estate investing, ask all your questions, talk about juggling a career and family and investing, and all the things that go along with that. We're going to have lots of interviews with experts in this field, and just talk about all the things that go through your mind when looking to analyze your first deals or your next deal. So join us here. It's a lot of fun, and we encourage all our members to pick a superhero avatar. And we can tell you how to get an avatar made up of you and post a picture of that in there. That's just for fun, just for fun. So feel free to join us there. Connect with me on all the social media platforms. Check out my website. Again, I'm happy to talk to you about anything. My website is full of free resources. I truly get the juggling us women do, and I'm so happy to help any of you in any aspects of your life that I can help you navigate. But real estate investing is my forte, so that is the one that I'm most able to help you with. But yeah, that never-ending to-do list, I get it. And so this is the easy button when it comes to investing. So happy to take any questions. After this, we'll stop the recording and let you hit me with whatever questions you want. And yeah, hit me up on LinkedIn, Facebook. I'll see you there as well. And it's been a pleasure. Thank you for spending time with me.